ETFs are often described as the easiest way to invest. With just a few clicks, you can buy a fund holding sometimes hundreds of companies instead of researching every single stock yourself. Simple, right? Well, that simplicity can be deceptive though, because two products labeled ETF can carry completely different investments and risks. One ETF might spread your money across an entire market. Another could concentrate it in one volatile industry. And if any of that went over your head, then fear not. My name is Guy, and this is The Bureau. And over the last few years, we've helped over 3 million people cut through the noise around money and markets. And in this video, I'm going to walk you through the 10 things you need to know about ETFs so you can decide whether or not they are right for you. Okay, so let's start with the basics. What exactly is an ETF? Well, ETF stands for Exchange Traded Fund. That might sound technical, but the basic idea is straightforward. An ETF collects money from many investors and uses it to hold a portfolio of investments. Depending on the fund, that portfolio could contain company shares, government bonds, commodities, or a mixture of different assets. Imagine ordering a platter of food at a restaurant. Instead of ordering and trying several dishes separately, you go with the platter, which has all their best food on one plate. In the same way, purchasing one ETF can give you exposure to every investment inside its portfolio. And by the way, the exchange-traded part means that shares in the fund are bought and sold on a stock exchange. You can usually purchase them through a regular brokerage account, much like you would purchase shares in a company. Their market prices can also move throughout the trading day as people buy and sell them. However, buying an ETF share does not mean the individual investments are placed directly into your brokerage account. No. You own a proportional interest in the fund, while the fund itself owns the underlying assets. That structure is what makes ETFs convenient and leads us on to the next thing you should know about them. And that is that ETFs can make diversification much easier. And diversification is one of the main reasons ETFs became so popular. Diversification, as you may be aware, simply means spreading your money across multiple investments rather than depending on the success of just one. It's the investing version of not putting all your eggs in one basket. So, suppose you invest everything in one company and it collapses. Well, in that case, your portfolio would take the full impact. But if that company represents only a tiny portion of an ETF containing maybe hundreds of businesses, the damage may be softened by the other holdings. One failure then becomes a dent rather than a complete wreck. A broad market ETF, for example, can give a beginner exposure to hundreds or sometimes even thousands of securities through one purchase. Recreating that portfolio by buying every stock individually would require far more money, time, and effort. An ETF packages that exposure into something much easier to manage. However, diversification is not some invincible shield. If the entire stock market falls, then a broad stock ETF will probably fall with it. No, diversification mainly reduces the risk of one company sinking your entire portfolio, but it can't eliminate general market risk. Also, it's important to note that not every ETF provides as much diversification as the next. And that's the third thing to know about ETFs. Not all of them are well diversified. An ETF may contain dozens of companies and still leave your money heavily exposed to one corner of the market. The number of holdings may make you feel like you're covered, but what those holdings have in common can really make or break the outcome. Imagine an ETF holding 50 technology companies. On paper, your money is spread across 50 different businesses, right? But if higher interest rates, new regulations, or weaker demand hurt the tech sector overall, many of those companies could fall together, not just one. You own several eggs, but they're still sitting in the same basket, so to speak. The same problem can appear in ETFs focused on one country, one sector, AI, clean energy, biotechnology, or any other narrow theme. These funds aren't necessarily bad investments, but they're more concentrated, which means their performance may depend heavily on one trend continuing to work. Even a broad ETF may be less balanced than it first appears. Because often in an ETF, the largest companies receive the biggest allocations, so a handful of giants can drive much of the performance. That's why just counting holdings is not enough. Before investing, you need to look beneath the label and see what the ETF actually owns. A fund can look simple on the surface while hiding very different levels of risk when you really dig into it. So, if you enjoy clear explanations of things like this that help you avoid making financial blunders, then you should subscribe to the Money Bureau newsletter. That's where we break down all manner of investing concepts and finance topics to help educate you on your financial journey. So just click the link in the description below or scan the QR code on screen. Okay, so let's get right back into ETFs, because the fourth thing you need to understand is what the ETF you're looking at actually owns. You can start by checking the investments inside the fund. Never assume an ETF owns something simply because its name includes words like growth, global, or technology. Those labels may sound informative, but they rarely tell you the full story. The ETF's fact sheet is essentially an ingredients list. Look at the largest holdings, the percentage allocated to each one, and how much the top 10 positions represent altogether. Then check its sector exposure, geographic breakdown, and total number of investments. You might be surprised here. A fund marketed as global might still place most of its money in one country. Another may hold hundreds of companies, yet devote a large share to technology. Neither is necessarily unsuitable for you, but you need to know what risk you're taking on. You should also identify the index or strategy the ETF follows. An index is not simply a random list of investments. It operates according to rules covering which assets qualify, how much weight each receives, and when the portfolio is rebalanced. These are important rules to follow. A market cap weighted index gives larger companies more influence, while an equal weighted index treats each company more evenly. This shows that two ETFs covering the same market can behave very differently. And once you understand what a fund owns, well then the next question is who decides what goes into it. And this takes us to the fifth thing you need to know about ETFs, the difference between passive and active ones. So, a passive ETF follows a predetermined index, such as one trading a broad stock market, a group of bonds, or a particular sector. Its job is not to find some superstar investment. It simply tries to mirror the index as closely as possible. This makes passive investing relatively mechanical. When the index adds, removes, or reweights an investment, the ETF adjusts its portfolio accordingly. Just like following a recipe, in fact. The fund may prepare the meal, but the index provider has already chosen the ingredients and quantities. And so, adjustments will be made accordingly. Now, on the other hand, an active ETF works very differently. Here, a manager or investment team decides what to buy, what to sell, and how much of each asset to hold. And those decisions may be based on company research, economic forecasts, or changing market conditions, usually with the goal of outperforming a benchmark, for instance. Now, this flexibility is very useful, especially in markets where opportunities change quickly. But it also introduces manager risk, the possibility that the people making those decisions simply get them wrong. Active ETFs also tend to charge more because research and portfolio management require additional work. Now, neither approach guarantees better returns. Passive funds can fall with the market, while active managers can underperform it. But one difference is always measurable, and that is what each approach costs you. And this is the sixth thing you must keep in mind when it comes to ETFs. Don't ignore fees. A small number can create a big difference here. Every ETF charges operating expenses, normally expressed as an expense ratio. So, if a fund has an expense ratio of 0.2%, roughly $2 is deducted annually for every $1,000 invested. You will not usually receive a separate bill either. The cost is simply removed from the fund's assets, reducing the return you ultimately receive. This can be compared to a slow leak that is barely noticeable, but increasingly important as your investment grows. Because suppose two similar ETFs earn the same return, but one charges 0.1% and the other charges 0.75%. That gap may look trivial today, but after several decades of compounding, the more expensive fund could leave you with substantially less money. Now, the expense ratio is not the only cost, however. Depending on your broker and location, you might also face trading commissions, currency conversion charges, or taxes. ETFs also have a bid-ask spread, which is the difference between the price buyers offer and the price sellers demand. Still, the cheapest ETF is also not automatically the best. A low-cost fund that gives you the wrong exposure is hardly a bargain. So, compare fees between ETFs designed for the same purpose, then consider what you receive in return. And some of that return may arrive without selling a single share, in the form of income. And that is the seventh feature of ETFs, and it's a big one. ETFs can pay you for holding them. If an ETF owns shares, some of those companies may pay dividends. If it holds bonds, those bonds may generate interest. And because you own a share of the fund, you are also entitled to a proportional share of the income generated by its portfolio. So, income generated. Cool. What happens next? Well, it depends on the ETF in question. A distributing ETF pays that income to investors, usually as cash deposited into their brokerage accounts. An accumulating ETF keeps the income inside the fund and reinvests it. This allows investors to purchase more assets indirectly without handling each payment themselves. And as we all know, reinvestment can support compounding, because the reinvested income may generate returns of its own over time. But remember, dividends are not free money added on top of an investment. When a fund distributes income, its value generally reflects that payment, and future payouts can rise, fall, or maybe even disappear. So what do we do then? Well, investors seeking regular cash flow may prefer distributing ETFs, while those focused on long-term growth may favour accumulating ones. And yes, don't ever forget the taxes. Taxes can also vary by country and account type, so always check the local rules. And also remember, receiving income does not make an ETF safe. The fund's price can still fall, and sometimes sharply. Which brings us to the eighth feature of ETFs in today's list. ETFs can still lose money. An ETF is still an investment. Its structure makes buying a portfolio easier, but it does not protect that portfolio from falling. When the assets inside an ETF lose value, the ETF itself usually loses value too. Even broad market ETFs can suffer massive declines during recessions, financial crises, or periods of market panic. Diversification is a good way to stop one company from destroying your portfolio. But bear in mind, it can't stop hundreds of companies from falling together when investors become fearful. And different ETFs carry different risks. Bond ETFs can fall when interest rates rise or borrowers appear less likely to repay their debts. International ETFs may be affected by currency movements, while commodity ETFs can swing sharply when supply, demand, or global events change. So, an ETF is a vehicle, not the destination. Two vehicles may look very similar from the outside, but one may be carrying stable government bonds, while the other is loaded with volatile tech shares. And what sits inside determines how rough the journey could become. So, before investing, ask how much the fund could realistically fall, and whether you could remain invested if it did. That matters even more with certain ETFs designed to magnify daily market movements. And this brings us to the ninth thing you should know about ETFs. Avoid leverage and inverse ETFs as a beginner. So, a leveraged ETF may target 2 or 3 times the daily movement of an index. On the other hand, an inverse ETF aims to move in the opposite direction. That allows traders to potentially benefit when the underlying market falls. Now, let's focus on the word daily for a moment. If an index rises by 1% today, a 2 times leveraged ETF may aim to rise by roughly 2% before fees, etc. But that does not mean it will deliver twice the index's total return over a month or year. That's because these funds reset every trading day. The gains and losses are repeatedly calculated from a changing base, creating a compounding effect. In a volatile market that repeatedly rises and falls, performance can drift far away from what a beginner might reasonably expect. It's like you're taking 2 steps forward and 2 steps back on a moving walkway. You may appear to finish where you started, but the repeated movement can still leave the leveraged product behind. These funds can serve specialized short-term trading or hedging strategies, but they require close monitoring and a clear understanding of the mechanics. Beginners should try not to buy them simply because recent returns look spectacular. No, a far better starting point is choosing an ordinary ETF that fits your actual financial goals. And that brings us nicely to the 10th thing to consider with ETFs: choose ones based on your goals. There's no single ETF that's best for everyone. The right choice depends on why you're investing, when you'll need the money, and how much uncertainty you can handle along the way. For example, someone investing for retirement in 30 years' time may be able to tolerate major short-term declines in pursuit of long-term growth. On the flip side, someone saving for a house deposit needed in 2 years may not have enough time to wait for a stock-heavy ETF to recover from a crash. Next, consider what you already own. If you think adding another ETF improves diversification, well, not necessarily if it contains many of the same companies as the existing funds that you hold. You could end up buying the same exposure repeatedly, and all the while believing that each new ticker has made your portfolio broader. Plus, you should also decide whether your priority is growth, regular income, stability, or preserving money for a near-term expense maybe. Once that purpose is clear, compare ETFs serving the same role by examining their holdings, diversification, fees, strategy, liquidity, and risks. And remember, don't choose an ETF simply because it recently delivered spectacular returns or dominates social media somewhere. Last year's winner may now be quite far down the ETF food chain. It might have already become overcrowded or vulnerable to a change in market conditions. Recent performance tells you what happened before and not necessarily what may happen next. So, a portfolio built from a small number of clear complementary ETFs is usually easier to understand and manage than one packed with overlapping themes. The right ETF for you may not be the one making the most noise right now. The right ETF is one you can understand and stick with during market downturns, but all with a clear goal in mind. Okay, let's now quickly bring together what we've discussed in this ETF knowledge list. ETFs can make investing cheaper, simpler, and even more diversified, but the label alone tells you very little. Before buying, always check what the fund owns, how its holdings are weighted, whether it's passive or active, and what it'll cost you over time. You know, the bare essentials. Then consider how it handles income, what risks sit beneath the surface, and whether it even fits your time frame and financial goals. And unless you fully understand how leveraged and inverse ETFs reset each day, they're best left to experienced traders. And finally, never judge an ETF by its name, recent returns, or popularity alone. Read the ingredients label before buying the basket. The right ETF should not be based on your excitement. Go for one that you understand and can confidently hold as part of a clear, long-term plan. And okay, that is about all for today, folks. But if you have any questions, please feel free to fire away in the comments down below. And if you enjoyed this video and think someone else would benefit from watching it, then do please go ahead and share it with them. As always, thank you so much for watching, and I will see you again very soon. This is Guy bidding you goodbye.